what I'm going to focus on today, Andrew's going to talk livestock here after I do my spiel here. But I'm sure if you're like me, you've been getting questions about input prices for the 2022 crop. You know, some of the challenges that are out there, some of the concerns, and it's a really difficult situation right now to kind of manage. But I do want to kind of step through kind of where we're at, where we might be going, and kind of some of the options or some of the tools that are available to help kind of manage some of the risks that we're seeing in markets right now. So I think the first thing that I want to start with is actually my take-home message, and this is the first one I think we need to really look at with the rise in price of some of these inputs. Is we really need to be thinking about profit maximizing decisions, not yield maximizing decisions. What's going to be the best in terms of what we know right now in terms of maximizing profit on an operation, rather than what's going to do the best to end up maximizing the yield. And then the second point would be we really need to be more aggressive than a normal year with output price risk management. There's a lot of tools out there to manage output price risk management. I'm going to go through one that I think is very applicable in today's market. But this is the type of context that we really have to think about in terms of how do we protect ourselves, because we're looking at what is our profit. Obviously we have some really good commodity price, and I'm actually, reasonably optimistic that 2022 we're going to hold some pretty reasonable commodity prices. You know, there's a lot of uncertainty out there, obviously, with what's going on in South America and then what we see in the spring in terms of plantings. But I'm pretty optimistic that we are going to see some pretty good commodity prices. The challenge is going to be what's that input cost structure look like, and what's our profit going to end up looking at. So just to jump right into it, I mean, this isn't going to shock a lot of people. Land prices and rents are up. Prices for most crop protection products and fertilizer are up substantially. Availability of inputs is a major concern. We don't know what we're going to be able to access. We don't know what we're going to be able to have in the spring. We're talking with some input suppliers. They'll say things like, I don't know if I can guarantee that. There are some indications out of the Midwest out of hoarding activity, which is counterproductive to working with us. And what I mean by that is it's similar to when we had the run on toilet paper during the COVID pandemic, because people are hoarding different chemicals, which obviously constricts the supply further. Embedded over top of that, speaking more general, is we have some substantial issues with labor shortages, which is incredibly challenging. And then trucking and logistical issues continue to hamper, the flow of inputs through the supply chain. And so, kind of the $1 million or $1 billion question right now is, will prices be cheaper compared to right now in spring of 2022? And that's kind of the I guess kind of the framework I want to work through on this. So the first one that I will show is fertilizer prices. These are out of the kind of the Mississippi River area. It's an aggregation that TTN puts together on fertilizer prices, and just comparing it to last year at this time, you can see anhydrous UAN and up 144 to 163%. We look at DAP, MAP, potash, they're all up almost double, some of them over double. The challenge that we see on this, and the question I get is, well, when are they going to start coming down? Well, when you look at this graph, they have not peaked yet. I don't think you can make a strong argument that they've peaked. The more relevant question to what we're talking about is, are they going to continue up and then come down so that they're at lower levels when we need to buy them in the spring compared to where they are right now? Or are we looking at it being cheaper right now relative to what we're looking at purchasing in the spring? We don't have a great answer to that question. We know that they're not going to get back down to 2021 levels, given the supply chain issues that we've ended up having. But you can make a valid argument that prices could be substantially higher than where they are right now, or we might see them flatten out or maybe come down a little bit by the time we enter that planting season. It's not unique just to fertilizer. Obviously, gasoline prices up 65%, diesel up 58% as we enter that. If we think about price direction on that, there's a few things that are obviously constricting that supply right now. One of the other ones that is kind of concerning is, depending on what we end up seeing in terms of having infrastructure bill end up implemented, does that end up moving the needle in terms of what we see in terms of having even higher fuel prices where we are? These are retail gasoline prices, but it does show the trend compared to the last year. and where we're at in terms of past years. So you can see we're at a high not seen since back in 2014. There's not other, you can look at crop protection products in a bunch of different ways, but this one is the producer price index by commodity for chemicals and other agricultural products. And so again, that price and availability is a major concern. There's a huge difference between different crop protection products in terms of what the prices are. I had got a quote from Chuck Danehauer out in Lauderdale County, and he said that the price that he got for Roundup was $55.30 a gallon. So obviously that's much more than the 1/3 increase that we're seeing on this index. So again, it's specific to different products, and then availability continues to be the major concern. Now, some of the root causes of this, obviously, it's been the logistical issues have been pretty well documented in the press, where we see global container freight rates compared to 2020 when they were down around that $1,200 to $1,500 range, where now it's a tenfold increase. Obviously, that gets passed along on the supply chain. When we look at the Baltic Dry Index, we have seen that come down after we ended up getting some of the Gulf ports operational down after the hurricane season, but we're still substantially higher than where we have been in the recent past. And so there are some signs that some of these shipping rates might be either flatlining or potentially coming down, but they're still way above year-ago levels, and that's going to be impacting any product that is shipped through ports. Tariffs on the fertilizer side of things remain a major issue. There's tariffs on different products out of Russia and Morocco. That obviously elevates the input cost of bringing that in. China's a major issue right now in terms of the energy crisis that they're experiencing. They've constricted their exports of phosphates, and they're responsible for 30% of the global phosphate export market. Now, we don't get a lot of phosphate directly from China, but anytime you take 30% of the export market off, it's going to have ramifications regardless of the origin that you're sourcing it from. And then again, we still have issues with production disruptions due to the hurricanes and COVID-19 shutdowns. This isn't something that is it's likely to persist, some of these logistical issues and supply chain issues well into 2022. So again, that's kind of the data that we have right now. The question I think that is kind of more important is, so what can we do about this? And so, historically, there's a few different things that we've looked at in terms of managing input costs. Timing, obviously, we can do some fall applications. Pre-purchases is always a big one. So a lot of this timing issues is, well, should I buy now or should I buy later? Can I get some applications out in the fall? Bulk discounts, pooling with neighbors to end up purchasing inputs, looking and around online or alternative sources of purchases. One that I think is important right now is the value of a relationship with an input supplier. It does give you at least access to a product. These tools right now in the current environment, you can see the note on the red, are not going to bring down prices substantially. This might assist you in getting access to some of these products. But again, managing or trying to end up negotiating lower prices on these commodities when there's an issue with availability is not overly likely. So when we look at kind of reducing the input costs, this is not an easy task. There's not a silver bullet that I can give you and say this is what's going to end up dropping your costs. So we do have to think creatively on this. So just a couple of real basic ones is soil testing. You have to know where you're at. What is in your soils? What makes sense in terms of looking at applying fertilizer? Can you end up getting away with reducing the inputs that you're applying for the upcoming crop year? And so that's one where I think knowing where you're at, knowing what you can do on a field by field level, I think is really important. The other one that is available in many parts of Tennessee is alternative nutrient sources, right? Can you get access to poultry litter, manure, or other sources of non-traditional fertilizer that can assist in that? I'm sure prices are creeping up on the poultry litter side of things, but they have not, from what I've been told, went up at the same rate as what we've seen in terms of commercial fertilizers. Eliminate products that are not contributing sufficient yield gains. There's a host of products out there. It's debatable whether you're getting the bang for the buck for them. I would talk with your agronomist or Dr. McClure about what are the essential products that you need to end up putting on those on those commodities. You will need a plan A, B, C if your typical inputs are not available. And so if you can't get access to Roundup, what's your next alternative? And so thinking ahead in terms of working out a plan relative to the commodities that you plant on your operation as to what you can end up doing, I think is going to be really important. Obviously, if you can prepay and get access to it, that does end up taking some of the guesswork out of there. But if you're waiting to see if prices are going to come down, I would have multiple contingency plans on what you can end up doing in terms of doing particularly the crop protection products. You do have to evaluate the rotation. Obviously, there's a lot of debate right now between high input costs like corn versus low input costs like soybeans. And so you do have to weigh those risks. Now, the big one that I always think that has to work hand in hand with that is what is the risk on the output side of things as well, right? We end up seeing, for example, and I'm not predicting this, but we see, soybean acreage in the US at 95 million and Brazil harvests a record crop. You can make a pretty valid argument that we would see a 9 in front of soybeans by the end of the fall. And so again, if you were buying or putting in a commodity, managing that output price risk, I think is going to be essential. Another one that I think is important to at least have that discussion, and again, this is not easy discussions to have with landowners, is to look at crop share leases and balancing that risk and reward. I'll go through an example of kind of what that looks like. And then looking at the maximum return to nitrogen for things like corn, right? When we're looking at this, the amount that we applied last year and the amount that we applied this year from a profit maximizing standpoint is probably not the same thing because we've seen the input price and the output prices change. And then I'll kind of close with talking about how to protect output prices and manage that margin. So when we look at this, prices right now, if you looking at futures prices and even adjusting for basis in Tennessee, the prices favor corn over soybeans, but the cost of production definitely does not. If you look at where we're at right now, this is the average of the December futures contract for corn and soybeans from December to March 31st, is kind of our planning interval. You can see we're at our lowest level right now. Obviously, we're earlier than this time interval than any time compared to 2013. So again, prices are on the side of corn, but those production costs and particularly fertility is not on the side of corn in terms of prices. This is one that we've been doing some back of the envelope stuff, and this is a really challenging one because I recognize there's a huge variability across the state of Tennessee in terms of what input prices are, what land costs are, and the machinery that's available to individual producers. But we've been doing some penciling out for 180 bushel yield target, and we're getting pretty close to $1,000 an acre in expenses. So we look at land, seed, fertilizer, chemical, machinery, and labor. But the one thing that I will point out is obviously our projected revenue right now. We are actually where we're making a small profit even at $944 an acre in expenses. What's worrisome is those expenses are continuing to still rise, right? So how long are we able to see a positive profit margin under this scenario, right? And the only way to really to come up with these numbers is to run them for individual operations. Everybody's cost structure is different, but what you really need to kind of pencil out is what are my current estimated expenses, and is it reasonable to expect them to either go up or down or remain the same? And then what's a reasonable estimate of what I can end up getting for the commodity that I'm growing under some type of yield target that you end up having. And so the ultimate thing that you want to look at is where's this profitability or this net returns table given different outcomes, having yield outcomes in the screen box of 160 to 190 bushels per acre for corn, and having prices somewhere between $5 and $6. I think those are reasonable assumptions with the information that we know right now. Things can change super quick, but when you're penciling some of that out, we do see kind of a mix of some profitable opportunities and maybe some that aren't. What is worrisome is the large area at the top of this matrix where we're looking at, there's a lot of, if we get a decrease in prices, there's a lot of negative outcomes and some pretty hefty negative outcomes on a per acre basis. And again, I'm not projecting that. What I'm talking about is managing the risk of that not happening or having an adverse effect. So when we look at soybeans, near $700 an acre, might be a little bit high on the chemical right now, but there's just so much uncertainty there. When we look at this, we talk to crop suppliers and they say, well, this is the price today, but I can't guarantee that that's going to be the price by the end of the week. And so it's just really difficult to try to end up, understanding what the cost structure is going to look like down the road, and even having an understanding of the availability right now. And so when we look at this again, what we're looking at is that total specified expenses relative to what that projected revenue is. And you get the net returns table that is similar to the one that I talked about with corn, where you're looking at between $12 and $13 and a reasonable yield of 50 to 65 bushels per acre. If you're got substantially lower cost of production, chances are you're probably going to have a little bit lower yield. But again, it's going to vary tremendously region by region. I do want to talk about crop share arrangements, because this is one that I think has kind of flown under the radar. Particularly for 2021, the 21 crop year. There's going to be some high crop share payments that are going to end up going out because of the good yields and the high prices. But what I wanted to look at was a comparison of what the projected crop share payments are looking like for 2022 compared to roughly this time last year. And what you can see is if you take out those expenses excluding land, you're talking about a very different risk structure. And so again, having that conversation, if you're on just a straight 1/4 crop share, so quarter of projected revenue or quarter of revenue, you may want to consider either moving to a fixed cash rental rate, or end up looking at sharing some of the cost of the inputs that are going to go into that land, because you have a completely different risk structure. And so when you see fertilizer prices, more than double, and you're just sticking with the same old typical crop share, I think that's a conversation that needs to be had if you're using these types of arrangements with landowners, just to try to end up spreading out that risk a little bit more equitably based on where input prices and availability are. This is a tool that I really like. It's actually out of Iowa State. But what this one here ends up showing is the maximum return to nitrogen. So you can put in the price of nitrogen, the price of the commodity, and it'll give you kind of a profitable range of application. It's highlighted in that box. And what I want to do is just kind of point out the difference between 2021 and 2022. And so when you're looking at 2021, we had corn prices, right just over $4, $4.17. And then we had the price of nitrogen around 40 cents a pound. Well, right now we're around that 91 cents and 5.50. And so what this is telling us is that under this modeled circumstance, the profitable N rate ranged from 166 to 199 back in 2021, whereas 2022, under the current circumstances, we're looking at a profitable N rate of 139 to 162. And so again, it goes back to kind of that initial point that I made, is we need to really consider managing for profit, not for maximum yield potential, because those two things are usually very different. So the other one that I want to talk about is the need for risk management. Obviously for our inputs, there's not a lot of tools that are available in terms of trying to take some of the price risks that are out there. You can look at some cross-hedging strategies if you're of a sufficient size. There are things you can do in terms of pre-purchases and that type of stuff, but it's pretty limited in terms of how to bring those down. And so the point that I want to make is that, there are easier ways to manage that output price risk, right? So making sure that we don't have a catastrophic result of, okay, we buy all these high input price, or all these inputs at high prices this winter, and then before we go to plant the crop, we see prices come down dramatically. That results in a catastrophic potential margin circumstance, right? And there's a lot of people, and rightfully so, crop insurance is a fabulous tool. We're still 3 months out. There can be a ton in the current environment. It is so unpredictable. There's a ton of things that can change in terms of price direction in the market. And so again, it's one of the ones, how do you manage that risk? So we look at where futures prices are. 550 is where we're at right now in December corn. Soybeans, that 1250 range. We have seen basis come down, but we expect that's going to come back up as we enter the winter here in December and January. Typically, our basis gets reasonably predictable at this time of year. So, I think there will be some opportunities to market that old crop corn and old crop soybeans, and then also looking out to potentially pricing some new crops. So when we look at the 2022 harvest futures, right now we're 550 for corn, and then that 1250 for soybeans. And what we've seen soybeans pretty much kind of moving sideways recently. It has kind of bumped up recently and is approaching the top of the trading range we've had since back in late June, early July. Whereas corn, we've actually seen it appreciate pretty substantially. And a lot of that is, there's some pretty big concerns about, are we going to get enough acreage here? And we don't have the concerns right now in Brazil of a huge corn crop. You have to remember, Brazil right now, they're producing their soybeans. Their corn crop will go in early 2021 and be harvested in our summer. And so again, we're looking at two different risk profiles in terms of what's going to enter the global market, which is influencing the prices that are available. So one thing that I do think is something that a lot of producers should consider is using put options as a risk management tool. And again, this is kind of a way to mitigate if you buy those high priced inputs, setting a floor for your output prices so that you don't get that margin squeeze if we do see a reduction in price. And so, the basics of a put option is it sets a price floor. One thing I really like about it is it's a defined loss that's equal to the premium of that put option. There's no margin requirements if you're just buying it, and it allows you to benefit if the futures market strengthens. So if we do see prices go from 550 and on the futures up to 650, a put option does not restrict you from participating in that market rally. And another one that's important in Tennessee is it doesn't set the basis, particularly for corn. We get very strong basis bids driven by our strong poultry industries and other demand users for corn, like the ethanol industry, livestock, and even distilleries as well. So there are some benefits to using this. And the other one that I really like about it is no requirement for delivery. If you use a cash forward contract, there's a requirement for delivery, where this put option will not add to that production risk. And so again, the one thing I do want to point out is this is not a tool that's going to increase your price. What this tool is going to do is you have to think of it as an insurance product. We pay our homeowners insurance not with the understanding that our house is going to burn down and we're going to get a payment. We do it as a risk management tool where we say we're willing to pay this to avoid this catastrophic loss. And this is the way I think that we need to conceptualize what we're doing with put options. And so the two important things when we look at put options is what is the strike price, and then what is the premium, and then those two combine to give you a premium versus a price floor. So when we look at this, obviously right now with the 2022 December corn contract at about 550, those at the money, so right around that 550 strike price is very expensive. You're talking 54 cents a bushel. What I want to focus on is kind of the tail of these strike prices, where what price makes sense for a premium to end up locking in a futures floor. And so I'll kind of go through two examples. I'll go through a more expensive option and a less expensive option, and we can kind of look at it from there. So first option is buy $5 December 2020 put option. Right now it's 27 cents. It sets a 473 per bushel futures price floor. If prices go above $5 on the futures, then obviously your option isn't worth anything and you're out the money. So again, what we're looking at this is if you have the commodity to sell, you sell the commodity at a higher price, but you take the 27 cent per bushel hit. If you do see prices retract and go down below the 473, so that's the $5 minus 27 cent premium, then the value of the put option is 473, whatever minus whatever that December contract is. So just kind of give it kind of, I guess, a bit of a more of a real world kind of example, if you have a projected yield of 180 bushels per acre, it provides a projected revenue floor of 851. Now that assumes that you get the yield, which, you know, it's not a guarantee. If you go 180 bushels per acre times 473, what you've got is $93 per acre that's unprotected if the yield is achieved. So when you look at the cost for a 1,000-acre farm, you're looking at about $48,600 for this. And what have you done? You removed about 86% of the futures price risk, which is a huge amount of risk. You're taking a lot of risk off the table for this. It might be a little expensive for some people to tolerate that. And again, you have to toggle this for what your estimated cost of production is. I use just that budgeted cost that I showed earlier of $944. What you really want to do is look at what your individual farm has in terms of the cost structure, and then trying to end up matching up with what your risk tolerance is in terms of price relative to what your production is going to be. Example two, this is kind of the catastrophic loss, right? And so when we think about this, you know, buy a 410 put option, we're well below what the current market price is, but it's substantially cheaper. You're only paying 5 cents and you're setting a 405 futures floor. And so again, same thing, if it's above if the price is above 410, you're not going to realize any gain off this strategy. But if it's below 405, then you will end up getting a gain from this strategy. Using that same 180 bushels per acre, you know, you're looking at protecting about $729 per acre in revenue. So the way to kind of think through this is how much of your inputs are you covering with the strategy that you're implementing in terms of strike price and the combination of expected yield. And so when we look at 180,000 times the 5 cent premium, that's 9,000. This is a really cheap option to remove about 74% of the futures price risk, and it still holds with the benefit, right? You can still end up pricing you know, basis, which in Tennessee is a big deal, and then also participating if that futures market rallies. And so again, this is a way to remove some of that price risk from the decision, while we end up protecting the inputs that we've sunk into the crop that we purchased before we put the crop into the ground. Just in concluding thoughts, and then I'll turn it over to Andrew and we'll have questions at the end. You know, between now and planting, nobody knows definitively if we're going to have input prices higher than where they are, the same, or lower than current prices. There's a lot of speculation out there. I think there's a lot of different opinions on there. The risk profile has dramatically changed compared to recent years. I think we need to be more aggressive in protecting, you know, price on the output side of things, and we have to get creative in terms of managing the amount of the inputs that we're utilizing in crop protection and fertility. When we look at crop insurance price determination, it's still over 3 months away. And, you know, if we think back of what type of changes we have seen in 3 months, it's been substantial. So again, I'm not saying that we're going to see some catastrophic set of events, but it is out there. As I mentioned, I'm still reasonably bullish prices, but I do think that, you know, managing that risk is essential in the current environment, particularly if you're buying inputs at the current level. If you're buying fertilizer right now, you're buying your crop protection inputs, that's a valid decision to make sure that you can secure the supplies for production. But at the same time, you've opened yourself up to additional risk if you're looking at, okay, if prices did fall, I've purchased my inputs high, and now I've got to deal with lower commodity prices. And so again, I think the big one is inaction is a decision, but it usually is not the correct one.